All right, so the next thing we're going to be looking at is a portfolio. Okay? So we know the saying, don't put all your eggs in one basket. Okay? So, with that being said, is that we don't want to put all our eggs in one basket, right? Because if we drop the basket, bad things happen, right? If we drop the basket, bad things happen. Now, the other thing that we want to be able to measure is, we don't want to put them in different baskets that are all carried by the same exact person. Okay, so we build up a portfolio. That's exactly what we're doing here. We are building a portfolio. And the reason we build that portfolio is so we can look at and we can figure out exactly and maximize our return. Right? Because we can build this portfolio, we can eliminate some of our risk, and we can generate a higher return. Okay? Now, when you look at that portfolio return, you'll notice this is a very similar equation to our expected return. Okay? It's functionally the same as our hat, right? It's functionally, we do the same exact thing. We sum up our weights, right? So our probability of that event occurring, we just are going to call these weights. How much of our portfolio is in this stock, and then we compare that to our rate of return. Okay? Now, we're just going to say that we have a 50% portfolio. We have 50% of our investments, 50% of our investment in DeHan Creek Distillery, and then we have the other 50% in Outlier Education Services. Okay? So what we do here is that we have two stocks. Okay? So we say N is equal to 2. Okay? And so this is, once again, is just a weighted return. Okay? So what we're going to do is we're going to put in, so it's going to be our weight of 1 times the return on 1 plus the weight on 2 times the return on 2 is going to tell us our expected return on the portfolio. Okay? So our weight on 1 is going to be 0.5, which once again, what do these add up to? 50% plus 50% is 100%. It always has to add up to 1, right? It always does. Okay? So we take that 0.5, we multiply it by the return that we're going to see on Security 1, which is DeHan Creek Distillery, which is the 14.25%. Plus, we're going to put our weight on 2, which is 50%, multiplied by our return here, which is 14%. And that's going to put us out to, we're going to have an expected return on our portfolio of 14.125%. Okay? It's just a weighted average here on our portfolio. What's going to happen with correlation in a portfolio? Now, when we talk about correlation, you should have already seen this in your statistics, but it's basically how things co-relate to each other. Now, the reason we build a portfolio is to diversify, right? So we don't have all our eggs in that same exact basket. The other reason that we do that is based off of this idea of firm risk versus market risk. Okay? Firm risk is kind of one of those things, and this is one of the things that we can really diversify. This is the reason that we diversify. Okay? Is let's say that we are looking at buying some stock, and we have General Motors, we have Ford, we have Toyota, okay, and then we have Volkswagen. Okay? So we're looking at these 4 companies. We can diversify some of our firm risk into spreading our investment out among these 4 companies, right? That's diversifying us a little bit. That is getting rid of some firm level risk. It's diversifying us away from General Motors declaring bankruptcy. However, all of these are all baskets carried by the same person. Okay? They are baskets that are carried by the same exact person. So what happens when that person trips and falls and drops the basket? All 4 of them are going to fail at the same time, and you're going to have a negative risk. Okay? So you can diversify some of your immediate firm level risk by incompetent managers. But you also want to diversify away from its sector risk. Okay? So this brings us down to that market risk. Okay? So we have our firm risk, right? Because even these companies up here, they're going to have different firm level risks. They're going to have different returns that are required on them. We come down to the market risk, however, and that's going to be the risk that we receive on the entire market, right? And so the way we define the entire market is we're either going to be using the S&P 500 or the Russell 5000. We're going to be using one of these larger pools. It's just going to be a pool, very diversified. It's across the entire market. Okay, and this is basically going to tell us, the state of the economy. Okay, and this is not something that we are able to diversify away. We can't diversify away the state of the economy because, we're all bound to it. We can do it to a certain extent. We can, invest in foreign equities, whatever. But there's this market risk premium is basically just that additional risk premium that we get from buying into the stock market. Okay, so we can buy into the stock market. That's going to have a higher risk premium than the bond market is. Okay, so we have this risk premium attached because stocks are inherently more risky than bonds. They are inherently more risky than U.S. Treasuries.